All right, let's talk about something that's been turning a lot of heads in the investment world. Every once in a while, a product comes along that just seems, well, almost too good to be true. And today we're digging into one of those, an ETF called YMAX that's making some serious noise for one very, very big reason.
And this is that reason, 62.9%. At the time we're putting this together, that is the advertised annual dividend yield for YMAX. I mean, just let that sink in for a second. That's more than 30 times what you'd expect from a typical S&P 500 fund. A number like that doesn't just catch your eye, it grabs you by the collar.
And just when you thought it couldn't get any crazier, there's this little detail. That enormous yield? It's not paid out once a quarter or once a year like most companies. Nope. It's paid out every single week. For anyone out there focused on generating cash flow, that sounds like the absolute holy grail.
Which, of course, brings us to the two most important questions you should be asking right now. First, how on earth is a yield like that even possible? And second, the big one, what's the catch? Because there's always a catch, right? Well, that's exactly what we're here to figure out.
Okay, so let's start peeling back the layers. To really get our heads around that insane yield, we first have to understand what YMAX actually is.
So here's the first key thing to know. YMAX isn't your standard ETF holding shares of, Apple or Microsoft. It's what's called a fund of funds. Think of it like a big basket. But instead of stocks, this basket holds a bunch of other highly specialized ETFs, specifically all the single stock funds from the YieldMax family, like their Tesla fund or their NVDA fund. The whole idea is to bundle all of their income streams together into one place.
So if YMAX is a basket of other funds, to understand how it makes so much money, we need to pop the hood and look at the engine that powers all of those underlying funds, because they all work the exact same way.
And that engine is a strategy with a pretty intimidating name, the synthetic covered call. Now, look, I know that sounds super complicated and full of Wall Street jargon, but I promise you the basic idea behind it is actually pretty simple once you break it down. And we can do that with a little analogy.
This really gets to the heart of the whole thing. Imagine a stock could either go up a little bit or it could absolutely explode higher, like a winning lottery ticket. What this strategy does is it agrees to sell away the chance of hitting that jackpot. You give up the right to capture that massive price explosion. And in exchange for giving up that potential, someone pays you a guaranteed pile of cash, right here, right now. You get income today by sacrificing the huge potential gains of tomorrow.
So it all boils down to this three-step dance. Step 1, the fund focuses on a stock, like NVIDIA. Step 2, it uses financial tools called options to essentially sell off the rights to that stock's future home runs. And Step 3, it collects the cash payment for selling that right. That's called the option premium. That premium is the cash that then gets passed along to you, the investor, as that big, juicy income. Now, as you can probably imagine, a strategy this unusual has kicked up a massive debate. You can go online right now and find one article calling YMAX a brilliant income-generating tool. And right next to it, you'll find another one calling it a dangerous trap. The whole argument really comes down to this, the promise versus the peril. The promise is that amazing weekly income and the fact that you're diversified across a lot of different stocks. But the peril, well, that's where you hear scary-sounding terms like NAV erosion and the idea that the yield itself is just an illusion. Let's look at the promise side of things. Here's a headline from a recent Seeking Alpha article. It's super bullish, saying YieldMax is a rare fund that can give you both income and growth-like performance. I mean, who wouldn't want that? But then, look at this. From the exact same website, just about a month earlier, a completely opposite take. This author says that Monster Yield is mostly illusion and that they would be a seller. So, what gives? How can they both be right?
To get to the bottom of this, we have to stop reading opinions and start looking at the actual facts. We need to follow the money. Let's decode the fund's distribution payment and see what it's really made of.
This is the million-dollar question, isn't it? When that cash hits your account every week, is it all profit and real income, or is there something else going on behind the scenes? And here we have our answer. This comes directly from YieldMax's own tax information. If you look at a recent weekly payout, you'll see that a little less than half of it was classified as income. The majority, nearly 56%, was something called return of capital. And that, right there, is the catch we've been looking for.
So what on earth is return of capital? Well, it's actually exactly what it sounds like. It's the fund taking a piece of the money you originally invested and just handing it back to you. It looks like a dividend, it feels like a dividend, but it's not a profit, it's a refund.
And because it's your own money coming back, it means the value of your actual investment, the share price or NAV, is shrinking over time.
So, this brings us to the most important part. Knowing this doesn't automatically make YMAX a bad investment, but it does frame it as a very, very specific trade-off. It's a choice you have to make with your eyes wide open.
So when you boil it all down, what are the big risks you're signing up for? Well, the fund's own documents highlight these three. First, your gains are capped. You sold that lottery ticket, remember? Second, as we just saw, the value of your investment can go down over time because of that return of capital. And third, those big weekly payouts, they are absolutely not guaranteed. They can swing wildly from one week to the next depending on how the market is behaving.
And so at the end of the day, it all comes down to this single personal question. This is the trade-off. Is getting a fire hose of cash in your pocket right now worth the very real risk that the value of your initial pot of money could shrink over time? For some people, the answer might be yes. For others, it's an absolute no. There's no one right answer. But now that you know where the money really comes from, you can make an informed one for yourself.